Wednesday and happy May Day, first day of May. Eric here, and this is our weekly uh, broadcast called Weekly Profit Talk. We do this every single Wednesday at 8:30 Mountain Time. That is 7:30 on the West Coast, 10:30 on the East Coast. We discuss simple topics about ways to improve the bottom line for your medical practice. And this is also a question and answer. So we're coming to you live, three different media: YouTube, Facebook, and LinkedIn. Um, and if you have any questions during the broadcast, pop them in. We will see them in our master chat window, and we'll address things as we can. Okay. In the absence of that, let me talk about this week's topic, which is how doctors can pay less in taxes. Now, you've got a serious consideration here because if you're aware of the tax code, simply put, the people that make more money have a higher tax bracket. That higher tax bracket causes you to pay more tax. And you may hear things like the rich don't pay taxes because of loopholes, this and that sort of thing. But chances are, if you're making over six figures or on your way to doing that, you notice that as your income progresses upward, you're actually paying more in tax by percentage as well. So there's things that you can do about this. One of the big ones is in the first 1 to 3 or 4 years of your practice is to forget thinking of yourself as a self-employed individual. Self-employment basically is reported on a Schedule C and generates another schedule called Schedule SE. And that one adds a second tax to all the money that you make as a business. That second tax, self-employment tax, is basically Social Security and Medicare. If you don't do something about this, you're going to pay both the employee and the employer side. So one of the things that you can do, and I would seriously consider, is doing the S corporation election. This allows you to be taxed as a corporation, but your income still flows through to your Form 1040. You take a reasonable compensation and pay a reasonable amount of Social Security and Medicare tax on that amount. The net income that you make left over is taxed only at ordinary income tax rates, and that can save you. For example, somebody making $100,000 a year, I can easily save them over $7,000 with this simple strategy. So that is certainly worth consideration. Next thing is as your practice grows and you need more flexibility and perhaps are also taking a look at the high tax bracket that you're finding yourself in as you progress past 24% up into the 30% brackets. Incorporation is a very viable strategy as well. This gives you some additional flexibility. One thing is that you're not limited to 100 shareholders, which is an S corporation election. Now, granted, that's a very small point to make because most S corporations are very small, one person to several people. In fact, but you may, in fact, want to bring more people in. Another thing to consider when you are considering moving from an S corporation to what is known as C corporation, and a C corporation is basically a separate entity. If you think everybody thinks of the large companies as a pretty good example, your Walmarts, your Target, that sort of thing. They're basically a separate entity that's taxed separately at 21%. We've been at 21%, lowered from 35% since 2018. And that is worthy of consideration on its own. Additionally, these taxes are paid by the corporation, not by a particular person, owner of the corporation. So you have as you make more money, more control of the amount of money that you actually pay tax on. Naturally, you're going to take a wage from your corporation, but that will reduce your taxable income in the corporation. That's one thing. The additional money that comes in from that can be paid out in dividends according to how a board votes. So C corporation is a very viable option as your business grows. Some other things you can do about taxes. One is simply internal and operational. You've got 3 levels of inputs that go into your profit. The money that comes in as gross revenue, that is reduced by payroll. And if you have raw materials costs that you make some sort of a widget, that as well, that reduces gross revenue down to gross profit. Then you have all the other expenses of running your business, everything from keeping the lights on, rent, advertising, utilities, travel if you have it, that sort of thing. And at the bottom of all of that, you have net profit. So simply, you can look at all of the facets, your payroll and all of the other administrative costs, and ensure that they're ordinary and necessary expenses, that you've got good strategies in place for having the best possible 5-star team working for you without paying more than absolutely necessary for that. In other words, basically internally self-auditing from time to time, and even doing micro forecasting and some mid to long range budgeting so that you have informed decisions about what you're doing in the future. Depreciation strategies are certainly important. You're going to have large things that you need to diagnose your patients. Anything over $2,500 that you purchase in a single year has to be depreciated somehow. There are some strategies for depreciating that 100%, if possible, and you qualify for them. But there are also a couple of bonus depreciations that remain in place, so they are being reduced year by year. Semi-large purchases of up to $2,500 actually can be expensed in the same year purchased, by the way. So that's something a lot of people don't know about. But the advantage to that is every dollar that you claim as an expense obviously is going to reduce your gross income to a much lower net income and lower your tax bite. There are some things that might give you some tax incentives, energy efficient purchases. There are specific hiring incentive credits available, as well as research and development credits. If you look into whatever your particular field's availability for these things are, or ask your tax person, certainly. And finally, it comes to light in the past 3 years. I've had a lot of medical professionals come to me with real estate strategies that they have been introduced to by the various interested parties in those things. And there's a particular term very attractive. It's called a negative K1. Basically, if you purchase rental real estate, you have an opportunity to write off quite a number of things that are tangible expenses, as well as one large intangible expense, that is depreciation on the real estate itself. Speaking of which, getting back to that, depreciation can actually take money that you're bringing in as a landlord, per se, and reduce that down to near zero or even negative. And of course, if you have a negative income source, reducing your other gross revenue, that is also going to reduce your taxes as well. And that just makes sense. So there are a number of things you can do to reduce your taxes as a doctor. And if you would like to learn more about that, or have questions, or would just like to talk to somebody about how you can better use some of these strategies, reach out. You can pop a comment or a question into any of the comments of our social media. We'll pick up on that for you. Both Facebook and LinkedIn, of course, have direct messaging applications. And if you pop your information into that, you will get a response within 24 business hours from us as well. So with that, I hope that I've shared even one or two things that might be helpful to you. And if you have any questions, let us know. And if you don't for this week, then keep in mind that we do this every single Wednesday at 8:30 Mountain Time, be that daylight or standard. And that is, of course, 7:30 in LA, 10:30 in New York. Until next week, happy first day of May. Have a great rest of the week, an awesome weekend. And if you have a chance, do something randomly kind for a stranger. So until next week, we'll see